Well, a very important voice. Remember, geopolitical tensions rise over Syria as Trump warns Russia to expect a barrage of missiles. The US president is still weighing options for military action against Syria and met with Defense Secretary Jim Mattis on Wednesday. The United States is considering retaliation against Syrian President Bashar al-Assad for an alleged chemical weapons attack last weekend outside Damascus. Trump, however, has not yet settled on a plan. So what does a possible escalation mean for global economy, markets and asset classes? Let's ask Alexander Wolf. He's Senior Emerging Markets Economist at Aberdeen Asset Investments. He joins us from Hong Kong. Alexander, good having you. Thank you so much for taking the time out. I think the markets, somehow it is a few participants believe that we've seen this cry of a wolf long enough. We don't want to be rattled by these tweets and the barrage of exchange of words. China this morning has told the US not to threaten them with escalation tones of a trade war. Russia is now pitching in as well on a completely different angle. Do you think asset classes are increasingly becoming a lot more thick-skinned to news flow?
Yeah, I think it's definitely the case that geopolitics are having a bigger impact. I mean, not only because we're seeing much more volatility around geopolitics, we're seeing risk creep up both on trade, which we haven't really seen in a very long time, but also in the Middle East, but also the threat of conflict between great powers. I mean, the threat of conflict in Syria would draw in U.S. Indirect conflict with Russia. That's also something we haven't really seen in a while. And I think it's not a coincidence as well with regards to the market reaction, the fact that this is happening at the same time that you're seeing a drawdown of very loose monetary policy, very supportive monetary policy. So I think in the past, during the era of QE and just very supportive monetary policy globally, that geopolitics wouldn't have as big of an impact just because the liquidity was so ample. But now as you're seeing liquidity withdrawn, it makes sense that geopolitics are having a bigger impact on the market.
So what is, Alexander, what is the bigger worry and which asset class should be the most worried? Is it the stone of heightened Fed moves, which anyways anybody doesn't know about really? As I don't think the Fed itself knows what the pace of move will be. Or is it the latest US Donald Trump tweets about Syria? Or is it the US-China trade war that stays in the background and makes a comeback every fourth day? What is the bigger worry?
That's a tough question. I think if you had to rank them, I think I mean the Fed has well signaled their moves, and you're right. The path of inflation is not really well known. There's a chance that they maybe move faster than the market expects, but I think the fact is that they've signaled their moves pretty clearly, and they signaled intentions pretty clearly. So I don't think that really ranks up there as a big risk. Syria definitely does, because it's a very volatile, unpredictable situation, and you have the threat of conflict directly between U.S. and Russia. Though I think that it's been a conflict that's been ongoing for a very long time. It's not clear what the end game is in Syria, and even when we see a U.S. reaction to the latest chemical strike or the latest chemical attack in Syria, I think it's unlikely that we'll see a very rash reaction, just given that he does appear to be advising with General Mattis and others that we wouldn't see a rash reaction that would draw the U.S. into conflict with Russia. So I think that does leave a trade conflict between U.S. and China. I know we saw Xi Jinping at Boao give a pretty conciliatory speech, and we saw Trump's tweets after the fact that seemed pretty optimistic about talks or negotiations beginning. But I think that there's still a lot of unresolved differences, and the economic impact of that is much greater.
Right now, everybody's eyes are focused on what could happen to crude, and there's an extension to gold because of the military conflict. But what asset class, to your mind, I don't know if you have a thought here, Alexander, but what asset class do you reckon would be the one that could be the most impacted? In the near term, it could well be crude. I mean, Saudi saying that they want crude at $80 a barrel because of Aramco and because of their economy is one thing. But with all of these geopolitical tensions, would the highly volatile equities be under question mark? Because quite frankly, they are sounding a lot more resilient than, or looking a lot more resilient than what they have in the past when such news flow has come in. Or do you believe commodities will be the ones which will be the most volatile and will be center stage of all investor attention?
Yeah, I think in the near term, it definitely makes sense that it would be oil, both around the potential chance for an actual conflict in the Middle East, but also I think with you have to think about the changes too in the Trump administration. You have Tillerson out as Secretary of State, being replaced most likely by Pompeo. You have Bolton in as a national security advisor, and so you have either people that are less willing to say no to Trump's impulses or agree with his more hawkish leanings. And so, especially with Bolton in as national security advisor, then that raises the risk of around the Iran nuclear deal and the potential chance for sanctions on Iranian oil snapping back. And so you have to think that oil would be under some pressure, whether it's from conflict or it's from the Iran nuclear deal. I think after that, then if you're thinking about a trade war as a risk, then it's definitely equities, I think, that could be under some pressure. If you actually do see tariffs put in place, granted they're more micro than macro, but the sectors that tariffs would impact would definitely be hit. But because of the nature of the global value chain in Asia, tariffs on Chinese manufactured goods would affect Asia more broadly, would affect the entire supply chain. So it would affect companies in Korea and Taiwan and Thailand, even American companies. And so you have to think that there would be some earnings pressure on the companies involved in tariffs.
Alexander, one last question. You do look at the emerging market scenario very, very closely. You are the economist out there. How closely do you look at India? Because almost everybody seems to be believing that India will be relatively unscathed around aside of the sentiment because of a much higher dominance of the domestic focused economy as opposed to the export oriented economy.
Yes, definitely. I definitely agree with that view. I think it's a relatively closed economy. It's not very tied into the Chinese, especially the Chinese supply chain. And it does stand, I think, to relatively benefit if you do see a rise in trade conflict, because you're right, it's a large domestic market. A lot of the companies are domestic focused. They're not necessarily relying on external demand. And so, relatively speaking, India, in the event of trade conflict, does stand out. However, you see oil prices rising from conflict in the Middle East. That definitely, I think, detracts from the India story, because you could see a rise in inflation. You could see the RBI having to move on the back of that. I mean, so right now you have a lot of conflicts, a lot of potential conflicts in the air right now. And so, just depending, I think, how things play out, India does stand to be relatively unscathed, but it depends how the oil price moves.
Yeah, well, actually, that's the big joker in the pack. Yesterday, in an interview to Bloomberg News, the Indian oil minister mentioned that we would much rather see oil at 50 as opposed to 70 or 80. At 80, it will definitely hurt. But Alexander, really appreciate you taking the time this early in the morning and talking to us. Thanks much for speaking to Bloomberg Quint.